Hello, investors and future investors. Welcome back to the channel. For today's video, I'm going to show you a simple option strategy that can be used if you're trading with a small account. Now, if you're new to option and you have a small account, then you just stumbled onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investor and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. In today's video, I'm going to show you a simple option strategy that anyone can trade if they're using a small account, or do I dare say a micro account. This option strategy can be used to grow your account portfolio on a consistent basis. Now, a word of caution before investing, always remember to do your own due diligence. No one is going to know what's best for your portfolio better than you do. That being said, let's go ahead and get down and dirty with options. For today's video, we're going to be highlighting the Spider ETF ticker SPY. So let's go ahead and we're going to go down to trade SPY options to the bottom. And then now we're going to go ahead and make sure it says sell and call. Now we're going to go ahead to choose our expiration date. The expiration date, just for the purposes of this video, is going to be January 10th. Now, as you can see here, that gives us about 5 days to expiration. Now, in order for this option strategy to be the most effective, it's highly advisable that you choose your strike price above the current share price. And for that, we're also going to be going with a high chance of profitability. So as you can see here, the chance of profitability is right here. So we're going to be going with a chance of profitability of 83%. Now, with a chance of profitability of 83%, that's going to lead us to the strike price of $600. So the top here, you can see strike price. So with a strike price of $600 and a chance of profitability of 83%, we're now going to be paid to do this option strategy. The amount we're going to be paid is going to be 0.92. If you were to translate that into real terms, that's going to be $92. Each option contract is multiplied by 100 shares. So why do we want to choose a high chance of profitability? Once you're trading with a small account, you will necessarily need to take more risk than someone with a bigger account. If you are going to take bigger risks, why not swing the odds in your favor by trying to get as high chance of profitability as possible while maintaining a premium you could live with? So we're going to go ahead now and we're going to click into this. And as you can see, this is the first leg of the option strategy. Now, this first leg of the option strategy is known as a covered call option strategy. So if you were to do this option strategy, the covered call option strategy, you will first need to own or control 100 shares of the SPY. So that means you'd be out of pocket about $59,000, which is going to be the share price of 592 multiplied by 100 shares. Now, I did promise you this is an option strategy that can work for a small account. In order for us to make that work for a small account, all we need to do is make a slight tweak. The slight tweak we're going to make, we're going to go over now to buy and call while maintaining the exact same strike date. Now we're going to go ahead and choose another strike price. This time, the strike price is going to be above our previous strike price, and that's going to give us the 601. So with the 601 strike price, we're going to now have to pay 0.72 or 72 cents. Transfer that into the real world, that's now going to be $72. You multiply 0.72 by 100 shares. As you can see here, this is none other than the call credit spread. Now, the call credit spread is perfect if you're trading with a small account. And as this video goes on, I will show you why it's so perfect for trading with a small account. Firstly, let's get to the good stuff. On this channel, we engage in option strategies that gives us a premium once we do the trade. So in this case, we're going to be getting a premium. The premium we will be receiving is going to be the difference between your 0.92 and your 0.72. Let's go ahead. We're going to hit continue. And then that's going to give us around $22 premium. Let's go ahead. We're going to hit review order one more time. And voila. Now let me break down this trade to you. In order for it to perform a call credit spread, previously you saw if you were to do the first strategy, you would have to come out of pocket of $59,000. Now you're able to trade the exact same stock, but now you need to come out of pocket only $100, making it very good if you're trading with a small account. Now, you need to leave $100 as collateral. Robinhood or your brokerage account is going to secure this $100 until the end of the trade, which is going to be your expiration date of January 10th. Once that day comes by, then I'm going to tell you what's going to happen to this $100. The best part of this option strategy and all the option strategies I feature on this channel is that we're going to be receiving a premium as soon as we do the trade. This premium is going to be $22, and that money is yours to keep no matter how the trade goes. Now, let's go ahead and explain how this trade could go. So, come expiration date of January 10th, if SPY is trading at any price below this $600 level, then we get to keep our $22, our premium. That's what we're going to keep, and that's what helps us grow our small portfolio. And now our collateral is going to be released back to us. That collateral goes back into your portfolio, and you could choose what to do with it. If you want to do this trade again, enter another trade, that money is now yours again for you to control. Now, the other way this trade could go, and there is 3 ways this trade could go. I will explain the third way a bit later on in this video. So the second way this trade could go, once again, come expiration date of January 10th, if SPY is trading at any price above your 601 strike price right here, then once again, the good news, you keep your option premium, but now you're going to lose your $100 collateral. Your total loss or your net loss is going to be the $100 you left as collateral minus the premium you receive of $22, which should work out to be about $78 loss. Now, it would be remiss of me if I don't tell you the ups and downs of performing this option strategy. As you can see, the first leg of this option strategy, I did mention you want to choose a high chance of profitability. So the chance of profitability we chose was about the high 80 percentile. If you have an 80% chance of winning a trade, that also means you have a 20% chance of the trade going against you. So if you were to do this trade 4 out of 5 times, you should come out successful. So use that knowledge before you enter into any of these trades. Now, there's another way that you could minimize your risk even further. And I'm going to go ahead and show you that right now. So before we do that, the reason why you had to leave $100 collateral is because you did what's known as a $1 wide spread. Let me show you. So your difference between your $601 price and your $600, that's going to be $1. You take that $1, you multiply by 100 shares, and what gives you your $100 collateral. The $1 is called a $1 wide spread. Now, in order for you to minimize your chances of losing this trade, here is one tactic that can be done. We're going to go ahead and we're going to get out of this. And now we're going to go to let's go to the 603. We're going to go ahead, we're going to go back in order for Robinhood to refresh our premium. And then voila, there you have it. So now our new premium is going to be around $55. However, our collateral has increased. Now, although your collateral has increased, your risk has decreased, and I will get to that right now. So this is known as a $3 wide spread. So the difference between 603 and your 600 right here is going to be $3, hence a $3 wide spread. And your $3 wide multiplied by 100 shares is what's determined your options collateral. Now, why is it less risky? Okay, I'm glad you asked. The reason why it's going to be less risky now, from expiration date, the SPDR ETF has to go past 600, 601, 602, and 603 in order for you to start losing this trade. Now, I did mention to you that there's 3 ways in which this trade could go. The third way this trade could go, come expiration date, if SPY is traded at any price between your two strike prices, then you do not lose all of your collateral. But once again, and I know you know the answer to this, you get to keep your option premium. So let's just say, for argument's sake, come expiration date, SPY is trading at 602. So now your collateral released back to you is going to be probably about $100, which is going to be the difference between 603 and 602. So that is the third way this trade could go. Now, the reason why this reduces your risk is that our previous example, your security strike price or your buy strike price was at 601. It's a lot easier for SPY to get to 601 than it is to get all the way up to 603. It has to go past this to get to this, and that's why this reduces your overall risk. Now, this option strategy, the call credit spread, is perfect for you trading with a small account. Before doing this option strategy, make sure to do your own due diligence once again. Secondly, if you're trading with a small account, make sure you use that to determine your amount of width you want with this trade. If you're trading with a $300 account, I don't think it makes much sense for you to do a $3 wide spread. That means you put in your whole portfolio at risk. So once again, no one is going to know the best thing for your portfolio apart from you. So the call credit spread is perfect if you're trading with a small account because the barrier to entry is very low. Your returns on this option strategy is also very high. Your return right here is more than a 10% return on a weekly basis. Just as comparison, the SPY gives a return of about 10% annually. You're getting more than 10% on a weekly basis. And this is what allows us to grow our small portfolio. Now, once again, each option strategy has risk. When you're trading with a small account, you have to take a lot more risk than someone with a bigger account because you do not have the funds available to do the other bigger, safer option strategies. Now, if you received any value from this video and you want to become part of the weekly income team, go ahead and check out the first link in the description below. Also, now is a good time for you to go ahead and like the video, subscribe to the channel. But most importantly, if there's someone out there that's struggling to grow their small portfolio, then maybe you could share this video with them. We're trying to help as many as we can. And until the next video, keep pushing your small account.